Hello, everybody. This is Chuck Carnevale, a.k.a. Mr. Valuation, also founder, co-founder of FastGraphs, the fundamentals analyzer software tool. And, I'm going to do something a little different with today's video. I get a lot of questions about, dividend growth stocks. Valuation is what my passion has always been. I've done a lot of blogging. I've written a lot of articles. I've produced Lord knows how many videos talking about the importance of valuation. And we are currently in a very high market environment. And I'm going to start by going through that. But what I'm going to really be talking about here is not so much individual stocks as I want you to see the process of building or how I would go about constructing a dividend growth portfolio in today's overheated market. So let me start by illustrating some of the characteristics of the S&P 500. I got this courtesy of currentmarketvaluation.com. I thought it was a very interesting graph because what it's doing is it's showing, first of all, the stock market going back all the way back to 1950. And the first thing I want you to notice is with certain periods of interruption, the long-term nature of the market has been generally going up. But you will get into periods of time where the market underperforms or simply doesn't perform very well. But the culprit is typically valuation. Overvaluation is really the worst in my opinion. And what I liked about this particular graph is the gray price line here indicates when the market was, at what I would call reasonable valuations. The green color-coded areas show times when the market was significantly undervalued. Now, if you are truly a long-term investor, and this is a long-term, this is in the mid-70s all the way out to the late 80s here, where the market languished. It really did nothing, but it was significantly undervalued. If you were an index fund investor, what a great time to be buying an index fund. Then we get into these periods marked in gold where the market begins to get overvalued and it gets to be separating from, what would be normal valuations or what I would like to refer to as fair value. And then we get into these red areas where you get periods where the market gets significantly overvalued. We saw that, of course, during the recession of 2000, 1999, 1998, which was also known as the irrational exuberant period where the market got really crazy. And then, of course, in 2008, we saw the market, gold, it was overvalued, but it was, on the cusp of becoming dangerously overvalued. And then, of course, the Great Recession came, and we know what happened after that. But then since the Great Recession, we've had this tremendous bull run. But what I really want you to see here is that the market has become dangerously overvalued. It's now entered, red territory again relative to this history going all the way back to 1950. So what I really want you to see here is that, it's a very expensive stock market right now. If you were an index investor, this would not be a good time to buy an index. Now, if you've been holding an index over the last 20 years, this would be an excellent, time for you because you would feel very, very good because your rate of return would have been very strong. Even if you bought it coming into the 2000 recession, the irrational exuberant period, and you looked at your long-term performance, you would have averaged about 5.6% capital gain. You'd have tripled your money almost in growth, and you'd have got about $4,499 in dividends based on a $10,000 investment made in 2001. However, if you would have taken this same investment and invested in the S&P 500 during the Great Recession when it was better valued, your rate of return jumps up to almost 8%. You in a much shorter period of time, you turned 10,000 into just under 27,000, and you received about 3,000 in dividends. And of course, the key point is this was a time when you had better valuations. I cut another couple of years off of that where you get the point where, let me make sure I hit it perfectly here, where you get the market really undervalued. Now, all of a sudden, your rate of return goes up to double digits. You've got a 13% annualized rate of return. You've quadrupled your money, and I might add in a shorter time frame, and you've also generated very substantial dividend income. So right now, we're clearly in a very expensive stock market. If you look at this market, over any historical norms based on earnings growth, no matter how you want to measure it, the market is trading at a very, very high valuation. The blended PE, the way we measure it on FastGraphs, is currently over 27, and you can see that's very, very high. Even back in the irrational exuberant period, the PE peaked at about 25. Coming into the Great Recession, the PE of the market was about 17. So the point is, this is not a good time to be buying an index fund. But one of my mantras, the things that I talk about all the time, is I'm very notorious for saying it's a market of stocks and not a stock market. Now, I've had people scoff at that. I've even had some very prominent investors scoff at that. One of the most prominent index investors has scoffed at that statement, saying it's really such a silly statement. I'm going to try to demonstrate in this video, it's not silly at all. It is a market of stocks. All stocks are not the same. They're quite different. But not only that, not all stocks, even though this market is highly valued, not all stocks are overvalued. There are a lot of stocks that are undervalued in this market. Now, common sense would tell you if you're in a bull market like we are right now, it's going to be harder to find value than it would be. When you were down here in February of 2009, just about every stock that I'll show you here today and just about every stock you could have looked at that had any type of quality or solid operations at all was probably on sale. It would have been a great time to buy. Of course, people were scared to death back then, and most people were, reticent to even buy stocks. They hated stocks because we had this huge sell-off in the market that preceded this great valuation, this great opportunity. But nevertheless, the market is overvalued, but there are individual stocks that are not overvalued. And so, what I'm doing is I'm always on a quest trying to identify stocks that are undervalued, and I do it based on investment objective. For example, if I'm looking to build a dividend growth portfolio, then I'm going to be scanning what I consider to be the premier dividend growth stocks on the planet. And, in Fast Graphs, we've preloaded 14 portfolios. Those include the dividend champions, companies with 25 years or more, dividend challengers with companies that have 5 to 10 years of dividend growth, and contenders that have 10 to 25 years of dividend growth, 10 to 20 years of dividend growth. But then I also have the vaunted S&P Dividend Aristocrat list, of which there are currently 66 names. I even have Canadian Dividend Aristocrats. These are companies, Canadian dividend growth stocks that have raised their dividends. So I've got all these lists. I can even just go through the S&P 500 and look at those. So I can go through these lists, and what I can do is, and I'll go with the Dividend Aristocrats, and I want to show you something very important here. I'll click this review button for you, and I organize these lists based on things like earnings yield, PE ratios, estimated growth rates, and dividend yields, and others. Now, I do this differently. I've got a lot of choices that I can customize this view of, but what I'm looking at here are the S&P Dividend Aristocrats. Now, I can organize those by things like earnings yield, which I have now, highest to lowest. So these are the companies that have the highest earnings yields. Now, what I'm looking for is a minimum earnings yield of about 6.5% to 7%. So you get down here to Archer Daniel Midland's, General Dynamics. We've got relatively, they're close, but they're not quite there. So in other words, I'm saying I want these a little cheaper. A 15 PE ratio is another benchmark that I use. And, like you're looking at General Dynamics with just above that at 15.9. But these stocks are close. Archer Daniel's a little bit higher. But then I go to all these other stocks here, and they've got low valuations, high earnings yields. Okay, so the first thing I'm looking at is the valuation, and I found it here. But if I go through this list, what I want you to see here is the first 8 companies on this list, 7 companies on this list are actually attractive. They have earnings yields that are above my 6.5%, threshold. If I go on down this list, you'll start seeing that the rest of these stocks have earnings yields that fall far below my 6.5% yield. So these are all great dividend growth stocks, all of them, literally. They're aristocrats. They're the creme de la creme. But some of them are just simply overvalued. Even the vaunted S&P Global itself, the company that's basically creating this list, is extremely overvalued right now relative to its historical norms. And you can see that just by clicking on the fast graphs. It's way above value. So the point is, I go through these lists and I look for companies that give me the right earnings yield. But I also have a whole lot of different dividend yields. Okay, so I can also look at it by dividend yield. So if maximum income is my goal, then I'm going to look for the companies that give me the highest dividend yields. But sometimes that doesn't give me the biggest capital appreciation. I've had a lot of controversy over names like IBM. Of course, the major oils like Chevron and Exxon are high yielding, but they have their issues right now. On the other hand, I got good quality companies like AbbVie and others that are giving me good dividend yields. But I've got to watch my valuation. That's one of the key messages I want to get across here. Now, what I do then is I go through all of these lists. I go through all these portfolio lists that I showed you, the Aristocrats, the Champions, the Challengers, even the S&P 500, and I use those to build. These are my own portfolios here. I have all kinds, but I created a dividend growth stock list. Now, these are companies that I've identified that I believe are attractive on a valuation basis, first of all. Now, I've organized this list slightly differently. I've got my earnings yield here, okay? And, this is what I'm looking for, the highest earnings yield. But I also got cash flow yield, because the reason I have that is if I'm looking at things such as, and let me go ahead and do this again. If I'm looking at something like a REIT, I really want to look at cash flow yield. I want a 7% or above cash flow yield, because REITs are going to be valued based on FFO. So, I'm thinking my way through this list. That's the point. But, I can also look at regular companies on cash flow yield. I want to make that clear. I've got companies that are generating extremely high cash flow yields, which mean which also tells me, by the way, simultaneously, that the dividend is very well covered. These companies are covering their dividends with very, very strong cash flows, which means the dividend is likely to be, continue to be paid and even be safe. But then I can also just do it by pure yield. I can look for companies that give me good yield, but I can also look for companies that have historical dividend growth records. That could be very, very important. And so I want companies that, have high rates of growth, but you've got to be careful with statistics. Statistics don't lie, but statisticians are darn liars. You've heard that a little more eloquently than I just stated it. So the point is, if I look at a company like Store Capital, it turns out this company had 1 year of very large dividend growth after they paid their first dividend. After that, the dividend growth is lower. But if I look at other companies, I can get some good historical dividend growth rates, and I'll go through some of those with you here in a moment as I kind of go through this video. But what I'm doing is I'm using all of these different kinds of companies. So let's look at some of the different kinds of companies that are actually available. Let's start with AbbVie. This would be one of my favorite dividend growth stocks right now, because it really gives me a combination of just about everything that a dividend growth stock investor would want. It's considered a dividend aristocrat, but that's pushing it a little, because the company's actually a spinoff. They were formed in 2012. But you can see they've put together a very excellent earnings record. You can also see by the white line here, they've put together a very excellent dividend record, and their payout ratio is solid. In more recent years here, it's been about 45%. So it's in the 40% range. Now, the stock is also very undervalued, in my opinion, right now. So I can look at it. What I've got is I've got an earnings yield of 9.87%. That's well above my threshold. I like that. I've got a very high dividend yield relative to the market. If you go back and we look at the market, I guess here we go. The market has a 1.51% dividend yield. So if I'm looking at AbbVie, I've got a 4.69% dividend yield. That's significantly above market. But I also have an opportunity. I've got good growth, and I've also got a good historical dividend growth rate. This one's been really phenomenal. Now, what I would do here is I would trim off that 300% growth rate, because that's very common when stocks, start paying dividends for the first year. They end up with this, very massive growth in dividends. So what I do is I trim a year off of there and get rid of that 300%, but I still have double-digit dividend growth. And even the last couple of years, going through COVID and everything else, this company's been raising its dividend in double-digit rates. So now if I'm looking for dividend growth, income growth, that becomes very important. Now, I use a yield on cost column here. I never use yield on cost. I want to emphasize this. I don't ever let yield on cost freeze me, okay? In other words, if you bought this stock on December 31st, 2013, your starting yield the first year would have been 3.3%. But then they raise their dividend every year. This is what I call this growth yield rather than yield on cost, because that's a characteristics I want and I covet. So I've got a stock here with a very high yield, great quality company that's growing my income dramatically. So, on my $10,000 investment, my first year I'd have got $331 in dividends. Last year I'd have got almost triple that. I'd have got $916 in dividends. And my yield on cost has risen to 9.2%. But I'm not concerned with that. My current yield and I really want to emphasize this, is 4.69. So it's not yield on cost that I'm worried about, it's current. If I can find something giving me a higher yield than that, and I'd be hard pressed to do it, by the way, as I've already kind of illustrated, I might, be able to, it might be rational to make a switch. But nevertheless, I've got a solid company with good growth prospects going forward. I've got 20 analysts, and 18 analysts forecasting 18 and 11% growth over the next couple of years. Then they do forecast a couple of weak year, a down year, and then a weak year. But, that's getting a little too far out for me to focus on. Right now, I'm pretty comfortable in these next 2 years. And so if I start just running the numbers, and I always do this, I want to emphasize this, when I'm making a decision, I can't buy the past, I can only buy the future. I'm trying to make a determination of what I can rationally and prudently expect this company to deliver if everything goes well. Now, the forecast is a forecast. It's, the only thing certain about the future is uncertainty. But based on these estimates and based on these earnings and based on these dividend estimates, if I invested in this stock and it reverted to the mean and traded at a 15 PE ratio, I'd make 45% annualized. I'd have a total gain of over 100%, and I'd have, I'd have a total gain of over 86%, counting dividends. I'd have a total gain of over 104% and a total annualized rate of return of 45% per annum with a company that's giving me a 4.69% dividend yield. So I can use AbbVie in a lot of different places, and I really feel like, this is a really undervalued stock. Now, the market has been valuing this stock since 2014 at about 14 times earnings, 13.78, and over this entire cycle, about 13.27. So if I wanted to be more conservative, I would go to the normal PE and run my number, and I still get a 30% annualized, 29.68 rounded, 30% annualized rate of return holding this stock, even if the PE only reverted back to a 12. However, I believe, as we saw numerous times here in the past, that this company is worth 15. So now I've got kind of a worst case or bad case or weak case, and I also got a normal case, which I would call the 15 PE, which tells me AbbVie would be a great option as a core holding in a dividend growth stock portfolio. Now, I can also go to quality companies like Kimberly-Clark, A-rated, household products, we all know their products. A very consistent company, moderate growth rate, about 4.7% a year. I got a 3.39% dividend yield, which is actually high. What I don't like right now about Kimberly-Clark, it's a little bit expensive. Now, it's trading more or less at a historical normal PE ratio. It does have an earnings yield that's slightly less. So in this case, what I probably would do with this, and what I am doing with this, is I'm waiting for it, hoping it one day gets down to this, PE. But I'm watching it. If it ever does, then I would buy it. Now, I had an opportunity to buy it for 3 or 4 years back here, during the Great Recession. I even had a period of time back in 05 and 06 where I could have bought it. So it's not unusual for it to get down there, and that would ratchet my yield up. And when I look at valuation from a standpoint of yield, obviously, the lower the price, the valuation, lower the black line, the higher the yield. Here I could have bought it at a 4.4% dividend yield. Here I'd have bought it at about a dividend yield of 3%. But I also, today I can buy it at 3.39%, but I'm also getting a slightly better payout ratio or higher payout ratio. So, when I look at the payout ratio, it moved from the 40% up into the 55 to 60%. But that, to me, is a benefit. Now, another thing, I didn't mean to leave it, I'm also getting a very consistent dividend growth rate, although the last 4 or 5 years, the dividend growth has been slightly less, but long-term, it's averaged 7.5. If I look at this over this shorter time frame here, that we've just looked at for the last several years, I'm down to about a 4% growth rate. All these things need to be taken into consideration when you're making a decision. But, Kimberly-Clark, if I could get it a little cheaper, it's got a good yield, certainly high quality, A-rated stock that I could buy. Now, then I can move on to Bristol-Myers, which, is obviously a pharmaceutical. And the company is A+ rated, and it's really expected to have a surge in growth here. And the market is valuing it at a very low valuation. The blended PE is under 10. I consider that extremely attractive. I got a 3% dividend yield. So I've got capital appreciation and dividend growth. When I look at its performance, I get a nice 3 or 4% dividend growth rate. I get significantly more income that I could get in the market, but I have to give up. I would have had to have given up some capital appreciation, but going forward, I'm not sure that's true. If you consider how overvalued the market is and how undervalued this stock is, I think this stock is going to be a superior performer over the next several years. And, no matter whether I use the normal PE, which, by the way, in this case, the market has a penchant for valuing it at a higher multiple than what I would call the fair value or intrinsic multiple. So I can still play the game and I can calculate my potential by running these different numbers. And I can even say, what if it only trades at this 9-ish PE ratio, which would be here? I still make 12% a year. So, I'm trying to analyze and evaluate everything, but I would incorporate this into my process and my thought process. Then I can look at names like McKesson, and I can look at names like AmerisourceBergen. Now, both of these are healthcare distributors. They've been beat up because of the potential of this opioid crisis. So that's not uncommon. This whole sector is. But what I love about these companies are double-digit growth rates, good quality, doesn't have much in the way of dividend yield. But if I was looking at McKesson, I'm really focused on total return here for growth. So if that was more important to me than income, I might consider this one over, some of the others that I've shown you here, because it does have a history of providing that kind of growth. If I, switch over to AmerisourceBergen, I got the same situation. I got a little better dividend yield here. I've got an earnings yield of about 7.26%. That's simply a PE under 15, and this has got an extremely consistent record. There's a lot of worry about it, but yet, quarter after quarter, year after year, this company keeps stacking on the results. And then when I look at it for my dividend growth rate, I've got a dividend growth rate that's spectacular. But again, I need to be careful with that, because the last several years here, that dividend rate has fallen to single digits in most cases. But prior to that, it was double digits. So I'm not living in the past. I also want to make that clear, guys. I'm living in the future. I'm looking at what I believe the future might hold. And, analysts are expecting the dividend to grow about 7 or 8% going forward. I get a nice double-digit rate of return out of an A- rated, company that I can buy, very inexpensively today. But it's a lot different than some of the others I showed you. That's the point. Oracle is old tech. Oracle is a classic example. It's got great growth. It's very inexpensive. Dividend yield is just under 2%, slightly better than the market. It has a 6.47% earnings yield. The PE is just a little bit above 15. I've got a good solid investment here if I'm looking for an A-rated company, that gives me good, consistent growth, something that I feel very comfortable with. The company's only been paying a dividend since 2009. So when I look at its dividend record, which only goes to 2009, I've got 30% growth. But again, I got a couple of anomalous years in here. So, if I shorten this down quite a bit, and try to get a better sense of average, I still have double-digit dividend growth. So I've got Oracle at a very attractive valuation. It's a high-quality company. I would expect to make, capital appreciation and dividend growth by investing in this company. But it's a market of stocks, not a stock market. What I hope you're getting a sense of is how different some of these companies truly are. Now, moving down the chain, I've got Omnicom. It got extremely inexpensive. It had a bad year. This is an advertising, company. You can see that, the effects of undervaluation, how it did revert to the mean. You can also see that when it got overvalued back here. It's a pretty consistent company, slightly above average growth. I get a 3.65% dividend yield even at today's valuation. And I've got forecast growth long-term of about 8% and short-term about 7.66. Gives me double-digit returns potential. And again, it's a BBB plus investment grade company with a great long-term record of increasing its dividend. So again, I can use this in my portfolio planning depending on what I'm trying to do. Now, if I'm really looking to ratchet up the yield, then I can look at things like REITs. Now, when I'm looking at REITs, I'm looking at funds from operations. And, here's Omega Healthcare, which is a healthcare REIT, obviously. It's got, very decent long-term performance here. The dividends have been absolutely phenomenal relative to the S&P. The potential return from this company has been significantly better than the S&P 500, looking at it from a long-term perspective. Now, as I change time frames, those perspectives change a little bit, but I still have a stock that dramatically outperformed the S&P on income, but slightly underperformed it on growth, if you will, over more recent years. So I'm going to weigh all these factors. I'm using this tool that I've developed called Fast Graphs to help me make decisions by weighing all the factors. Long-term growth, short-term growth, but ultimately all my decisions are made on what I expect the future to be. Now, this company is not expected to grow very fast going forward, but I still can get double-digit total returns on this stock through a combination of a 7% current dividend yield, a low valuation, that means I get just a little bit of PE ratio expansion, and it makes up for the low growth I have. I can make some nice money on this stock going forward over the next 3, 4, 5 years, but I get a very nice yield. So if I need more income than some of these other stocks are going, I could blend an Omega with another one of these growth stocks. I can do the same with an oil and gas storage and transportation company like Enterprise Partners. Now here I got to deal with a K1. If you hire a tax accountant to do that, he can handle a K1 very easily, but some people really hate the K1. But what I've got here is a steady, consistent, very high yielding dividend growth stock, if you will, that has increased its dividends at a rate of about 6% a year. But you can see it just buries the S&P and actually comes in a dead heat almost from a standpoint of capital appreciation. So what you've got here is another one of those stocks that you can utilize for increasing the yield. You can blend this with a 3% grower, for example, and end up averaging something closer, above 5%. As an example on those, if you marry the two together. It's the concept, the process that I really want you to see here or to get focused on. Then I can also go look at something like CVS with a 2.5% dividend yield. We all know the company, the drugstores. Stock is extremely cheap, and there is some risk in this company. And I want to point out they don't expect it to do much with dividend growth going forward for the next several years. But having said that, the company really makes up to that in terms of how inexpensive it is. Growth is expected to be about almost 6% per year. Longer term growth expected to be only about 3.5% a year. But the point is, I can buy this stock so inexpensively that if it gets back to a 15 PE, I stand to make quite a bit of money, even at an 11 or 12 PE, okay, which is, just around where it's currently trading at, just slightly above. I still have a chance to make double-digit rates of return, assume all these things happen. But my point is, it's a very, very different marketplace out there. It's very hard to find good value, but it's there. I've got 55 stocks on my dividend growth buy list here that I was showing you earlier. And and there's others out there. I don't have all the REITs included here. I don't have all the oil and gas. There's all kinds of high yield investments out there as well. But what I do have here is an opportunity to pick and choose among all these different stocks here. And I can, organize that by, I can look for highest dividend. If I'm looking for real high dividend yield, I look for that. If I'm looking for high dividend growth, I can go here. If I'm looking for best valuations, I can look at earnings yield or even PE ratios. If I'm looking for quality, I can sort these by credit ratings and look for the highest. And, and I've got Apple in here, and I'll just sort of end with that. I've said this so many times before, this is probably my favorite stock. I've made as much money in Apple as I have in any stock I've ever invested in over my entire career. And the reality of it is, I love this company. What I don't like is its valuation. It's as simple as that. So, this is an example of a stock that I just consider to be dangerously overvalued. If you bought it back here, look at all these years where you can buy this stock at a fair value. This simply makes no sense. Okay, I don't care what interest rates are doing. I don't care what all the things Apple's involved in. This is a $2 trillion company that's forecast to grow at 13% a year, but it does not justify a 33 multiple. It would justify a 15 to even a 20 multiple, I'd say, would be fair, but it's extremely overvalued. So I'm trying to avoid these kinds of names, but I've got plenty of other choices that have similar growth rates. I've showed you a couple here, the AmerisourceBergen that are growing at double-digit rates that I can buy at attractive valuation. So the point is, I use my various screens here that I can go in. I can go in and look at all these portfolios, and I can screen these stocks by all the things that I've shown you here, and then I can use that screen to start building together, my own personal portfolios that I can evaluate and look at that can help me put together a portfolio that meets my specific goals and objectives. And that's the real point, final point I'm trying to get across here. You need to have specific objectives and then look for stocks that meet that. And, even if I go through the S&P, you can see I've got, nice earnings yields here going with a lot of these stocks. But, once I start digging deeper into here, you can see that these high earnings yields disappear very rapidly, and I start getting down into some very low earnings yields as I scroll down this list of 500 plus names. There's an awful lot of really great companies out there that are just trading at nosebleed valuations, even though they're great companies, and I'd love to own them, but I can't buy them when I can only, when I don't get an adequate enough earnings yield. But I can also pick and choose amongst any of these portfolios that are available there. Anyway, I hope you enjoyed this. It's just what I'm really focused on. Forget about any of the names that I was showing here. I was just trying to show you what kind of diversity there exists among the stock market. Not all stocks are the same, certainly. And it is a market of stocks, not a stock market. And so what I always like to tell investors is mind your owned, not own, but owned, O-W-N-E-D. Mind the stocks that you own. Mind your owned businesses. That, to me, is the best advice I can give you. And don't worry about what the market's doing. Focus on what you own and a relative valuation of each. And then when you're building a portfolio, build it with a plan. Have a plan and follow that plan. To me, that's the best investment advice I think I can give everybody. So many people just buy stocks amok. It's this. They have hundreds of stocks in their portfolio. I like 15 to 20. That to me, that's more than enough to diversify my portfolio. It's also a small enough number that I can pay a lot of attention to and try to learn about and understand as closely as I can. And those are all principles that lead to long-term investment success, at least in my opinion and experience. Hope you enjoyed this. Obviously, give me a thumbs up and a like. Subscribe if you haven't. And I look forward to talking to you again very soon. This has been Chuck Arneville saying thanks for watching.